A recent interview with the president offered some clarity about his policy priorities: permanent tariffs, consistent commentary on the direction of the Fed, and laser focus on his remaining 3.5 years. But will those priorities last? As the White House pushes what they call one big beautiful tax bill, and while federal deficits could be approaching 7% of GDP, markets are constantly recalibrating. So, how are these policy shifts reshaping trade, taxes, and market fundamentals? Well, we're going to break that all down for you right now on UBS Trending. Hi, everyone, and thank you so much for joining us for another episode of UBS Trending. I'm Anthony Pastore, and I'm so happy to welcome back to the studio my good friend and colleague from PIMCO, Libby Cantrell, Head of Public Policy. Libby, thank you. I know you've got a lot of meetings like this that are happening. You're in high demand these days, so thanks for coming by.
Always time for you. Always love being here, so thank you.
Thanks, Libby. Let's start, because tariffs are really the big story. And when you look at Google, something like from the time that Trump was inaugurated, the search for tariffs on Google was up like something 1,600%. People were wondering, well, what are they? How do I know what to do with them? How do they affect the economy? So that seems to be something that clearly is a word that is probably the word of the year for 2025. Where are we now? Because there's a lot of back and forth. Will they figure out some path with China? Because the president says no. Treasury Secretary Besson says maybe, and then there's the UK deal that is really just getting inked and stuff. Where do we sit right now with tariffs? What's your thought?
So one, just to zoom out for a second, is that the president believes in tariffs. He has called tariffs the most beautiful word in the dictionary. This is not a new ideology. You go back to the 1980s, he was talking about tariffs. He was against NAFTA in the 1990s. He was against China's accession to the WTO in the early aughts. So he believes this, and I think that oftentimes the market doesn't want to believe that he believes it. So that is, I think, a really important backdrop, that he uses tariffs as a means to an end to extract concessions from our trading partners, but he also uses them as an end unto themselves. I think this is important, because I don't think the market wants to think that these are as sticky as they are. So right now we have what's called an effective tariff rate. Basically, if you take all of the tariff measures that he's announced, tariffs on non-USMCA goods, tariffs on aluminum and steel and autos, that 10% baseline tariff, and 145% tariffs on China, that all equals to about a 15% effective tariff rate on all of the imports.
Across the board.
That was 3% as of before the inauguration. So from a 3% to 15%, that is effectively a tariff shock. Our view is that we're not going to go to the 30% that you would see if he added all of those reciprocal tariffs and everything else he has threatened. But still, even if he stays at 15 to 20%, that is going to be a headwind for the economy, and that will also put pressure up on prices. But again, I think that his pain tolerance, what he has shown us in Trump 2.0 versus Trump 1.0, is that the pain threshold is just much higher. Again, he has this worldview. He feels like there were a lot of things that were left undone from the first administration that he is committed to doing. So I think the upshot is that while we should expect some positive, headlines around deals with the UK and Japan and India, it's really important for markets and for investors to focus on the signal and not the noise. The signal is that we're going to have significantly higher tariff rates, and that, again, at least in the short term, will have economic impacts.
Yeah, and looking at the bigger picture then, if again, zooming out once more, and coming off of the Fed statement that came out this week, now we know the Fed left rates unchanged as was expected, but Powell and the FOMC said there's a lot of uncertainty around the outlook for the economy. Obviously, they still have their dual mandate in place for jobs and also inflation. But given what you're talking about in this 15% effective rate, how does that affect us economically?
Yeah, and Powell was obviously very careful trying to not criticize the president, but also to sort of observe the reality of the situation, that tariffs, at least historically, have been a headwind to growth. So our view was that you were coming into 2025 with a 2-2-2 forecast, 2% real growth, 2-ish inflation, closer to 3, and then probably 2 Fed cuts. Fast forward to today, that outlook is more like 0% growth. So we're still not calling for a recession, but definitely kind of flatline growth.
Sure.
3 or if not 4% inflation, and then probably 3 to 4 Fed cuts, but more towards the end of the year. We think the Fed really is going to have to see cracks in the real economy before they will move forward. And I think, Anthony, we all have to have humility here, right, in terms of economic forecasting. The country has never seen tariffs this high, or at least they haven't seen it for 100 years.
Century.
So, and of course, the global economy, our economy, is much different now. So this is what we expect. But I think, again, everyone has to have a degree of humility here, because maybe it's worse or maybe it's better. And we'll talk about some of the things from Washington that will be intended to make things a little bit easier.
Yeah, absolutely. And just to kind of reiterate our view here in CIO, which is similar to yours, we expect about 100 basis points in rate cuts by the Fed, perhaps starting in September and going into 2026, look likely 25 basis points per meeting. So it seems to be a lot in line with what you're saying.
Exactly, yeah.
I mean, it looks like it's going to be tough for the Fed to get that 2% inflation that they've been wanting since 2021.
Exactly.
It's going to be difficult.
And I think for Powell, who at this point is very concerned about his own legacy,
Of
right?
course.
Because we are on the heels of a higher inflationary period, he is really going to be worried about those inflation expectations. And if they do cut sort of too soon or preemptively, there is a risk that you see those inflation expectations increase. You actually have seen them pretty muted in the tips market, but there is that risk, and we think he's singularly focused on that in some ways.
Probably the next thing that Washington's going to have to really focus on is this tax bill,
Yes.
already we're seeing some disparities in the Republicans that are sitting in Congress, where it looks like 5 of them now from blue states, New York and California, are saying, well, we don't want to have the SALT deduction be a max at $10,000. We want it to go up. And so there might be some, stalling out there. Where are we now? What are your thoughts on this tax bill?
Yeah, I mean, this tax bill is going to be difficult to get done.
Yeah.
Keep in mind, as you know, Republicans have a 2-vote majority in the House. This is the skinniest majority that they've ever had in the history of the party. So this is this is going to be difficult for them to actually get through. My view is that it's always easier to give kids candy than to take away their toys, meaning it's easier to give tax cuts versus actually pushing through spending cuts. And that's also on the table. I think there are some folks who are still concerned about the deficit in Washington. They don't want this to be a total deficit buster, and they're insisting on spending cuts. So while the SALT caucus is insisting for a more generous SALT deduction, there are also folks at the same time that are insisting on spending cuts. What we think will happen, though, is probably a bigger bill from a deficit perspective. Table stakes are that extension of the Trump tax cuts that expire at the end of this year. So those will all be extended, probably for 10 years. Maybe they'll be made permanent. And then I think the big question, though, for markets and for the economy is what additional tax cuts will we see? Because those, of course, are going to be the things that will be actually stimulative. An extension of policy, it's expensive, but it doesn't actually stimulate the economy. And so that, I think, in our view, will be more front-loaded in order to help mitigate some of these headwinds from tariffs. So they will include, no taxes on tips and no taxes on overtime. But you also could see some business tax incentives that could be applied retroactively that could also help to mitigate. So we don't think that the effect from tariffs will be completely offset. But again, this could actually help animal spirits. It could sort of reduce some of those headwinds that are likely to occur from tariffs.
And you make a really good point. With only 2 seats, ahead for the Republicans, if you've got 5 of them who are going to be pushing back because of the state and local tax deductions, it could really cause a problem for Mike Johnson and the rest of the Congress.
Yeah, and to his credit, he has navigated this very thin majority very well.
Yeah.
And of course, don't underestimate the bully pulpit of the president. I mean, my view is this will likely get done by August, maybe September, but probably August recess.
Before they go out on recess.
Folks like to go on their recess, and they want to have some good things to sell to their voters.
Sure.
And I think that the president will be instrumental, and just in terms of really kind of pushing forward on those potential holdouts.
Yeah, and with a $36 trillion debt in the U.S., there's really a lot at stake here.
There's a lot at stake here, and we were saying before the election, the deficit was likely the biggest loser, regardless of who wins. And I think our view is still that the deficit is likely to be going higher because of this. We could see, as you said at the beginning, we could see 7% deficits. Now, of course, if GDP declines, you could see closer to 7.5% or 8% deficits. We'll see, right?
Yeah.
But we are looking directionally at still a very high deficit for what has been a pretty good economy. So, I think the kind of the big question our clients are asking us is, what does that mean for markets? What does that mean for the long end of the yield curve? What does that mean for the dollar?
Yeah, what does that look like then? If you look at, we've done the first 100 days already, what does the next 100 and beyond look like? Especially given, as you said, we might not get that tax bill passed until the end of the summer, and we have a long road to go when it comes to tariffs and negotiations. What does that look like for us?
Yeah, I mean, again, we've been, to use this sort of metaphor, food metaphor, we've been given a lot of vegetables, right? And we haven't had a lot of the dessert, and we will get the dessert in the tax bill. Again, it's just a question of portion sizing and what have you. The vegetables, I do think, are going to stick around, though, and so we're going to be forced to eat those, I think, for the duration of the Trump presidency. But our view is that Treasury yields, we were talking about this before, are pretty attractive right now.
Yeah.
But being active in terms of where you are actually getting that exposure, we like the belly of the curve from the 5 to 7 year. We still have sort of a steepener on, kind of avoiding that long end of the yield curve, which is going to be more sensitive to term premium. And then we also like, global duration. So we like duration in Australia, interest rate in Australia, in Canada, in the UK. So we definitely, we like the US, but we also, are using our flexibility in order to actually get exposure elsewhere. We don't necessarily buy into this idea that the dollar is losing its reserve currency. That's, I think, I was out at the Milken conference, kind of number one question outside of tariffs was that question from our clients. But we do think that two things can be true. One is that the dollar is likely overvalued coming into this year, and so we will see a repricing of the dollar. But also, we don't necessarily see this as being a blanketed referendum against the dollar. You can't replace something with nothing. Gold has a natural limit to it. Crypto has a limit to it.
Of course.
And so we still are the most liquid, the most deep market, and we don't think that's necessarily going away. But what we are seeing incrementally is folks kind of marginally diversifying away from the dollar.
Yeah, exactly. And we talk a lot about U.S. exceptionalism, especially in the last couple of weeks, and that's been coming into conversations. Here at CIO, they do think that investors should maybe use some positions to go into precious metals, but obviously a diversified portfolio, especially with so much uncertainty, is really the way to go at this point in our history.
Yes, exactly. And that's what we're telling clients as well. That this is actually, there are opportunities that have been created by this uncertainty and this volatility. This is actually the time to look for those opportunities versus sitting on the sidelines. But as always, a more diverse portfolio with hopefully some active management embedded in it is always the way to go.
Exactly, especially coming from somebody who's from our partners at PIMCO. Well, thank you, Libby.
Exactly.
Always
Thank
a pleasure.
you so much.
Get you back soon. Love your insights. I know we've been talking about this election into the presidency now for a few months, so it's good to see how we're going and what your thoughts are. Great to have you here, my friend.
Thank you so much. Appreciate it.
See you soon. Thank you.
Thanks.
Again, thank you to Libby Cantrell and all of our great partners at PIMCO for their continued partnership with UBS and our clients and advisors. And for more information on everything coming out of our Chief Investment Office and our great partners like PIMCO, visit our Insights website at ubs.com/views. Plus, we're on social media at UBS. You can follow us at LinkedIn and Facebook. You can also check us out on Instagram. At UBS Trending is the name of the account. You can follow all the studio's content that you're not going to get anywhere else. And as always, please make sure you're continuing this conversation with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day, and remember to keep your eyes on what's trending. We'll see you soon.